see through your skin. I'm not your guardian. I can't see through your skin. Can't see through my skin.
All right, welcome, guys. Hello, everybody. Hopefully you can hear us okay. You guys want to do a quick mic check?
Yeah.
Check.
How's the audio, guys? Just give us a quick hell yes in the chat if you can hear us okay and see us clearly. Welcome. This is what episode is this? 57.
Wow.
Man, we've been going. We've been doing these for a while.
Yeah.
Awesome. All right, I think we're good to go.
Yeah.
Welcome, guys. We've got a big show for you. Travis is going to tell you how to become a billionaire over the next decade.
Basically.
More or less. You know.
Today's Travis's show.
Yes. We're just going to sit back and kick it to our homie, the Stock Geek. And no, I'm just kidding. We've got a lot to cover, though. Actually, I want to lead in with the biggest crisis of the year so far. This is terrible news
More
for
than
any
the
meat
Chick-fil-A
eaters.
sauce being in shortage?
You know, we tested that theory a couple days ago, and they had sauce in stock, so I'm not too worried about that
Yeah,
one.
they didn't sound concerned at all about the Polynesian
Nope.
crisis. Polynesian sauce crisis.
Yes. They had honey mustard, they had Polynesian, they had it all.
All
We're
the
good.
goodies.
1/5 of U.S. beef capacity wiped out by the JBS cyber attack. This stuff seems to be happening more and more and putting even more pressure on the supply chain. And this time, our New York strips and fillets are really feeling the heat.
That's a travesty. Maybe not for the vegans, but
For us, it is. I'm a meat eater, unashamedly. But yeah, I don't know. I mean, this is kind of in line with the show's kind of theme, though. You know, talking about where the markets are headed and what could potentially be a really big trade over the next decade, and just trying to think about how to position ourselves. And yeah, I don't know what's going on. Where do you guys want to start?
With this, I was trying to look really quick to see what any of the cybersecurity stocks did today. I was trying to quickly pull it up, but I don't know if
What are the main ones?
You got CrowdStrike, Palo Alto Network.
Yeah, I was just
Fortinet.
curious. As this stuff starts to happen more often and really affect our lives, are those companies going to start to kind of get a pop in price?
Yeah.
Just based on that.
Yeah, we'll see. I mean, it's definitely needed, and it's funny because the whole we have to cancel Bitcoin or ban Bitcoin because of ransomware. I think people that wrote those articles are now realizing how stupid that proposition was and how it really doesn't matter. The with or without crypto, this stuff is going to keep happening, and the problem isn't cryptocurrency. The problem is shitty security. So anyway. Let's go ahead and jump into it, guys. So, right now, the fear index on Bitcoin pretty high. We've come down over the past few weeks from the highs around 60K to right now we're in the mid 30K zone. You got stocks that are still sitting up here around all-time highs, kind of flat over the past week, I guess. But the real story, I think, recently has been obviously commodities, right? So we've had oil that's up quite a bit ever since going negative last year.
Can you believe that happened?
Yeah, what a crazy thing. I don't know if anybody actually got fills on that, right? It was really hard to trade, but
You could have gotten liquidated. I know some people I don't know anybody, but there were the articles written about the guys who were buying the negative oil prices thinking that it was a bargain and didn't realize that there was no place to store it. So the contracts kept going more negative against them. They got margin called and lost their shirts.
Yeah, a lot of
crazy.
people learned how even securities like USO worked back when that happened.
Yeah.
Just how the oil futures worked, how
a lot of people got a
ETFs
lesson in
worked,
that. Yeah.
Yeah, USO almost got wiped out. I think we talked about that on at least one of these episodes back around that time frame in April or May last year.
Yeah.
So.
Yeah. Well, let's go ahead and get rolling. So, guys, first and foremost, this episode is sponsored by YCharts. YCharts is a great tool for running just basically different fundamental research, macro research, and we're going to dive into some of the charts here. It's also sponsored by our community, Skill Incubator. If you haven't checked us out and you want to develop your skills, go check us out, skillincubator.com. And with that said, let's just go ahead and jump into the meat of what we really want to talk about and what I think a lot of people are really here to figure out, which is what could be the massive trades over the next decade and what's the narrative that is going to be driving this, right? Because I'm more of a technical guy, right? Like my sweet spot is, trading momentum in between, a few weeks to a few months, right? I'm not a macro guy. I can't think years and years into the future. I'm not smart enough to do that, but you guys are. Nikki, certified financial planner. Travis, former hedge fund manager, now managing his own capital and teaching the community, and you have some ideas that you wanted to share, and I'll just pass it to you, man.
Yeah,
take the reins today.
Yeah, we were talking about topics for the show this week, and the thing that has constantly been on my mind since the end of 2020 has been this idea of inflation and markets worried about, will they worry about inflation? How are bond markets going to move? How are equity markets going to react? So I've been thinking about this, and this is one of those moments that I feel like if you can nail the inflation trade over the next year or two, you could make a significant amount of returns in capital because there are so many different asset classes tied to whether or not we're going to get sustained inflation. And the performance of those asset classes, whether it's bonds, crypto, stocks, whether it's commodities. I mean, everything is sort of riding, every single asset class's performance over the next several years is riding on whether or not we're going to get sustained inflation above the Federal Reserve and other central banks' targets.
Yes.
So we're seeing, and we have seen for the past 5 months or so, at least some building of expectations of reflation, which means, we went from deflation last year during the pandemic to more of what we would call a reflation, a rise in prices because of a lack of supply in certain areas and rising demand. So you're starting to see things like, everything from energy prices going up to used car prices going up to agricultural commodities, corn, wheat, soy, all of those are up. We've seen gold and silver prices starting to perk up. And so What's interesting, though, on the other hand, is that you've seen things like crypto down in the past month significantly. You've seen bond yields go flat over the past month or two. The bond market is actually saying, now, because let's back up. It would almost seem obvious to say that inflation is the trade you need to be positioned for the next several years, but that's not what the bond market is saying. The bond market has trillions of dollars worth of notional capital and derivatives behind it. And the bond market is essentially saying, not only when you look at yields, inflation swaps, inflation break-evens, it says it's not concerned about sustained inflation more than like a year or two out. So when we look at, say, the 10-year yield or the 30-year yield on U.S. Treasuries, you can see this, right? They're still priced well below 2%. And that suggests below the Fed's target of 2% plus inflation on a longer term basis. Mm-hmm. And then when you look at things like inflation swaps, so you might say to me, well, Travis, you know, the Fed is buying bonds, so they're manipulating interest rates in the Fed market. Well, we could also look at things like inflation swaps, which are a market for institutional investors where they trade fixed interest rates for floating interest rates. And you can essentially tease out what the expectations for not only short-term but longer-term inflation rates are. This chart here from Bloomberg, from a macro trader I follow, shows the 1-year inflation swap, the 10-year inflation swap, and the 30-year inflation swap. And what is it telling us? Well, the 1 year is suggesting that the inflation rate that the market is expecting right now is just south of 4% for the year. Well, that kind of makes sense. We have seen the CPI ticking up above 4%. But the 10-year and the 30-year swaps are only suggesting like 2% or less of an inflation rate on a longer term basis, on a multi 10 plus year time frame. So what that is saying is the bond market is essentially believing the Fed when the Fed says we just see transitory inflation. We see a reflation this year as things return to economic growth again. And as we get back to higher employment levels and all that, and consumer spending starts to normalize, we'll see those rates start to taper off as we move forward through the year. That's why the Fed isn't raising rates. So again, the bond market's agreeing with the Fed, but you've got a lot of really smart people: Stanley Druckenmiller, Ray Dalio, Bill Gross, legends in macro, in calling, what's going to happen in the macro economy and taking big bets with their hedge funds. They're essentially saying they're concerned. They don't believe the Fed is correct. They don't believe the bond market's correct. They don't believe the currency markets are correct. They believe the dollar's going down and yields need to go up and that stocks could get crushed, right? So this is so interesting because there's so much that hinges on this. That's why I said, I think if you can nail this trade in the next 1 to 2 years and position yourself correctly, this could be the trade that makes every other asset class, irrelevant sort of in a way, because if you can nail this, you can then know what happens to stocks generally, probably on an index basis.
And when you say nail this, you mean if you can create a thesis around what inflation or deflation scenario is going to play out and then put capital behind that, and then when you have that kind of macro thesis in place, you go in and you be tactical and find specific opportunities that match that?
Yeah, absolutely. I mean, I'm a stock picker. Like I shouldn't even be paying attention to the macro, right? My skill set is in picking stocks, but you can't ignore, one analogy is like if you're a surfer in the ocean, you can't ignore what the weather patterns are doing. You can pick your waves and you can find great waves on a given day, but you're not going to ignore the weather, right? You're not going to ignore the macro variables around you.
Yep.
And so even as a stock picker, I've got to be cognizant, because as we saw, like in the spring, for instance, when there was a big shift in stocks from growth stocks being super hot to value stocks then taking off, and growth stocks actually took a big dive. These things can have effects, especially if you're positioned in certain areas of the market.
Yeah.
If for instance, if you believe that inflation is going to overshoot the Fed's target for multiple years running, then you probably should be long energy, miners, stuff that has been really lagging the market over the past few years, and not be super long the growth stocks trading for 20, 30 times sales.
Yeah.
So it has implications for how you position your portfolio, even as a stock picker.
Yeah. So I guess I do kind of follow some general like model of that, right? Like with Bitcoin back in the early days, my thesis was, okay, well, smart money's going to come in, institutions are going to come in, hedge funds, blah, 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 and that's going to drive mass growth, right? And then inside of that larger thesis, I traded the momentum, I traded the market cycles, right? So I'm also like thinking about the next 10 years, what does that look like too? Like what's the kind of the big picture narrative in the crypto space? And then how can we go in and be tactical with that? And then that also ties in obviously to inflation stuff, because if inflation isn't going to be just short term, that's obviously going to be bullish for hard assets like Bitcoin, gold, real estate, things like that. Right.
Yeah.
And then how do you, like you said, like inflation, fears or just data is starting to tick up right now, but Bitcoin's down, right? Why is that? Well, there's not a direct correlation, right? Bitcoin is driven by much more than just a macro narrative. It's, you know, it's people getting liquidated. It's market cycles that are driven by fear and greed, right? So even if you're long-term bullish, you've got to temper expectations and know how to trade the shorter term cycles. Or if you don't want to trade, at least know how to time your entries to where you're not going to take an 80% drawdown, right?
Yeah. And the stock market, too, has been trading like it's believing the Fed's narrative that inflation is going to be short term. I actually found it quite surprising that the stock market has held up. You guys know, for weeks on end, I was kind of looking for that rollover and sell off to have a deeper correction, but it just never came. And then we're, you know, now trying to retest and break out to all-time highs. I would think that if the market believed that inflation was going to be sustained for a long period of time, that we'd see that in the equities market starting to show weakness in the price, but that's not happening, at least yet.
Right.
So I think that, yeah, overall, the general, I guess the herd is saying this is transitory, it's short term. We're not going to worry too much about it. We're not going to pile into bonds. We're not going to sell our stocks. You know, we're going to stay risk on. And it's, I feel like it's actually, we're kind of coming up to a tough crossroads, because you have all of these inflationary pressures right now that obviously you can see sustaining for a long while if the administration continues to spend and they carry the deficits that they're talking about carrying. Obviously, we've talked about that. But I can also see a case for the economy continuing to grow and being strong. And, you know, so it's kind of, and I'm curious, Travis, how you're thinking about that, because it does kind of feel like pulling forces right now.
Yeah, that's a good point. So yeah, I want to definitely get deeper into the two sides here, because there's some, I think, important things to think about. And I'm struggling with it, to be honest. I'll tell you straight away that I'm leaning in the inflation is going to surprise camp. Just based on some of the past environments that I've studied. However, there are some smart people in the deflationary camp still. Lacey Hunt of Van Hoisington, I mean, this is a guy who nailed the bond bull market for like 20 years, and he still says that we're basically going to be in that same deflationary, you know, longer term environment. And there's a lot of money to be made if you actually believe what he believes. I think David Rosenberg, one of the pretty popular, famous economist, he also is in that camp of deflationary.
I've heard many people in the deflationary camp. I've listened to that, and that is true.
Yeah. And as investors, I think it's smart, like, just to tell everybody that's watching this or listening on the podcast, like, we don't try to pick a side, right? Like, we just try to look at the data and figure out what actually is going to play out, right? And leave our own bias out of it. And I think it's really smart when the market's at kind of like an inflection point like this, and instead of just trying to predict what's going to happen, look at both possible outcomes and figure out what is the trade for each one of those. And then the more and more evidence you get that one of those is playing out, you can build your position sizes and lean heavier and look to trade momentum and things like that, right? Is that how you would think about it?
Yeah, I mean, I think that's a great way to try to play it. That's what I've done so far. Like, I haven't taken a dramatic stand one way or the other, but I've been thinking about as we get more information, how do we get asymmetric bets on these types of scenarios, right? And so you might be looking at things like, inflation swaps or derivatives on, puts on the dollar, stuff like that, right? There's lots of funky ways to play it with potential asymmetry. Maybe certain stocks, right? Like I mentioned, maybe some mining related companies, right? Call options, leaps on those types of things.
Yeah.
Puts on some of the higher value tech stuff. So I think that's kind of the Druckenmiller approach, is like he might position his portfolio initially in a way that sort of reflects a slight bias. And as he gets more information, he'll make that trade larger and larger, similar to what happened with Soros and the pound and things like that, right? As things start to reveal themselves, they can add on size and lean into it. So I think that's a pretty good approach. But to be honest, I'm trying to figure out if I can call the turn. I am trying to figure out if I can,
pick a side.
There is
essentially,
significant money to be made. Like I said, right now I'm definitely geared more towards a bias for inflation is going to surprise to the upside. But I'm trying to poke holes in that, and I'm trying to figure out how might I be wrong, and what would be the way to play it if I am.
Yeah. So, okay. So let's talk about what the huge trade would be in that surprise inflationary scenario. Like what are the potential things that would be on the table that we could look at and say, okay, obviously timing is going to matter and size and all that. But in the event of surprise inflation, what are the assets that we're going to look to go heavy into? And I do think it's kind of interesting because the narrative of like, oh, we're going to have zero interest rates forever, that's been so prevalent that, the more people you can catch off guard and the more pain you can cause people, usually the bigger the trade is.
Yes.
Right?
That's exactly why I wanted this to be the topic of our show today, because, I can try to double and triple down on why this is so important, but we have been in this environment for probably 2 decades, more or less, of just kind of continued decline in interest rates with some shorter term spike ups, right?
Yeah.
But investors have been lulled into this view that the Fed is going to take care of everything and that interest rates won't go out of control, that the Fed's not going to be stuck between a rock and a hard place having to, raise rates. A lot of people say what can't happen won't happen, in the sense that the federal debt is so large now that we can't have 5% or 10% government interest rates. I do sympathize with that, but at what point does the Fed have to raise rates at some point? Like if inflation is running at 6-7%, I'm not saying it's going to, but if that were to play out, what's the Fed going to do? And investors aren't prepared for that. Investor portfolios are not positioned for that on an aggregate institutional basis.
No.
Yep.
Not at all.
So
that would be the trigger that would cause a lot of pain.
Yeah.
And that would be a setup or a layup for some really profitable trades.
Yes.
Right.
Yeah.
So let's look at some data and then look at some charts and talk about some potential trades. So the first chart we've got pulled up here is the ISM Manufacturing Index, so PMI.
Yeah.
Trav, you want to just say what this is for anybody that isn't familiar with it?
Yeah, it's basically an index that tracks, this one's a U.S. based manufacturing PMI, but it tracks a few different components of the manufacturing sector, from orders to prices to employment within manufacturing specifically. And there's also an ISM for non-manufacturing that covers more of the service sector. But this shows, we're getting pretty. I mean, these are multi-year levels now. We would expect to see some of this as we get the reflation and the reopening of the economy, of course. But when you actually dig into some of the comments behind the ISM manufacturing report from the last couple months, it's pretty shocking. I mean, supply chains do not look like they're getting fixed in the next 3 months. In most cases.
Yeah.
Big
And
labor shortages.
massive
They're
labor
having
shortage.
to increase prices.
Yeah.
I quote from the latest report, prices charged by manufacturers are also rising at unprecedented rates linked to soaring input costs and unparalleled capacity constraints.
Yeah.
So,
And we've got, there's a lot of comments in there about starting to pass on price increases.
yes,
And so
I did see that.
Yeah, and so what we're seeing is that we know that it's usually difficult once firms start passing along price increases. They're usually pretty sticky. It's
Yeah.
usually difficult for them to pull that back immediately. And same is true with wages. You know, when wage rates rise, typically they don't fall immediately back.
Yeah.
This isn't something that flips 1 month back and forth.
Yeah, once you start giving people raises
Yeah.
and raising prices, it's very difficult to reverse that.
Yeah.
You know what I thought was interesting? So we yesterday actually on the boat we were having a conversation with a guy who's he manages a large mortgage company over the state of Texas, and he works with a lot of builders. And we knew that builders were already having issues getting lumber and things like that. But he's like, dude, the problem goes so much deeper. And he was saying they're having like sand shortages, which means they can't make brick, they can't make windows. And he said that they're actually offering people that signed contracts on homes like 6 months ago that haven't even barely started construction. They're offering $50,000 cash to the buyer just to walk away from the contract because it's cheaper to pay somebody 50 grand to walk away from a contract
Than to
than
try
it
to
is to
build.
build it at the elevated price levels. That is crazy. That's going to send a systemic shock through the system, I think.
Yeah. Yeah.
It's already starting,
It's
but
wild. I mean, sure, some of this stuff will get worked out with enough time, but, you know, some of this stuff is going to create, I think, you know, more medium-term implications. And one of the things that really concerns me is, did you see what happened with Exxon last week?
no.
I don't know. I can't remember if I don't think we really addressed it on the podcast, but Exxon lost a proxy battle. So basically there's an activist fund called I think it's called Engine One or Engine Number One. And this is like I don't even know who runs the fund. I need to do some background research on that. But this is a relatively new fund, and they don't have a ton of capital. I think they owned less than 1% of ExxonMobil's stock. You know, ExxonMobil used to be like one of the largest, if not the largest company in the world at one time by market cap, still a multi-hundred billion dollar market cap company. And Engine Number One essentially got two of their appointees appointed to the board by getting the index investors like the Vanguards and the Fidelities and the BlackRocks of the world to essentially vote their shares in favor of Engine Number One's nominees to the board. And Engine Number One's nominees to the board are all about putting in Exxon on a path to like some
Renewable.
ESG, you know, essentially getting out of oil and gas, new oil and gas projects. So you have one of the largest oil and gas exploration and production companies in the world, and you've got a little shareholder that comes along and says, we don't want you to be producing oil and gas in the future, which is strange, by the way, that a shareholder would come into a company and say, it's almost like voting against your own interests. But anyway, the point being here, what happened was they were successful. Engine Number One appealed to the index investors who were trying to be ESG friendly. They got two of their board members appointed to Exxon's board. And that was relatively, I mean, it was a coup, essentially, because Exxon, the entrenched management of Exxon was pushing back, trying to say, no, this is bad for our company. But Engine Number One got, as a small shareholder, worked with these index holders who have, you know, probably 20, 30, 40% of the shares, and got them to get on board with this whole ESG mandate. So what does this mean on a broader sense? Well, it says to me that a lot of traditional oil and gas companies could come under fire from ESG mandates, and the threat is real. And we could be looking at an inability for oil and gas companies to essentially start any new projects if the ESG mandates continue. So this won't happen obviously overnight. This is something that'll play out over 10 years, maybe 20 years, but it's a shift that's saying essentially like the world is going to force energy companies into a very tight supply situation. And so we see that oil prices have been going up for the past, you know, several months. And a lot of that has to do with shorter term supply demand imbalance. But longer term, I think a lot of people are starting to turn their heads and say, we could be seeing 100 plus
barrel.
100 plus a barrel crude prices, no sweat, and maybe even higher, maybe 150, maybe 200 is not out of sight, because if oil and gas companies, at least in developed markets, can't, you know, create new production, you've got a serious supply constraint that's not just temporary, like the Fed is saying. It's potentially long term.
Yeah.
So
And taking a look at just the oil like weekly chart going back to the big boom and bust back in 2008, we actually just broke a pretty key trend line here. Again, this is just one part of the puzzle, and obviously there's a lot of fundamental factors that matter more than a trend line, but it is interesting to see after, making the world turn bearish on oil prices, it's basically way, up from, call it, 10, 15 bucks where it was really trading in the spring of last year, up over 60 now. I could see that becoming more of like a reflexive trade, right?
I would say nobody is really thinking about that.
Yeah.
What he just outlined. Most people are like, oil's dead. It's, if anything, it's going to be not in existence in however many decades. But we need oil for a lot more things than just, fueling our vehicles.
Yeah.
And I mean, is that being factored in here? Like all the different things that go into production of different materials?
no, it's not.
I mean, it's not like we don't need oil, right?
Right. No, it goes into plastics. It goes into-
Decades out, maybe, but in that short term, over the next, 3, 7, 10 years, right, oil could be 100 plus.
Yeah, no, and it's an interesting transition period. I mean, to be fair, if you are a very hard proponent of, say, solar and wind and renewable energy, you actually kind of want higher oil prices because you want solar and wind and other, hydro and other types of energy sources to be more cost competitive than ever. So actually high crude prices is probably a good thing in their view, but it's going to be painful. It's going to be really painful. If we're seeing $100+ barrel oil for the foreseeable future and maybe higher, this could get really painful for, your average middle class consumer who's probably not yet transitioning to EVs and still has to buy plastic products off the shelves of the grocery store. There's airplanes are still going to run on jet fuel for the foreseeable future. That's not going.
That's going to be a tough one to get on an EV plane.
And with demand going up, I just saw the FAA numbers were back to their highest peak since pre-COVID. You predicted that. I mean, we're going to get back to those levels and probably then some just because of the pent-up demand, right? So I've noticed airfares are already higher and planes are getting packed out since they took out that middle seat rule.
Yep.
I have an anecdotal situation. I've got a flight coming up, and my flight was changed 3 times because of issues that the airline is having with filling up flights, and they're having to reroute people. And I just got notification after notification, and I had to call, and I'm like, is this it? Is this my flight? Like, you keep changing this on me. And they're like, I'm sorry. It's just,
was it like staffing issues, or did they not tell you?
I mean, they didn't get into the details, but it sounded like they're just having a hard time with the logistics right now with all of the demand.
Yeah.
And, flights filling
Makes
up.
sense.
And
Actually, talking about flights, let me see if I can find this. American and Southwest put off plans to serve alcohol because passengers are acting like dicks.
man, people
there was a
ruin
lady
everything.
that got a flight attendant woman that she got assaulted, and I think they knocked her teeth out. Yeah.
Oh my gosh.
A Southwest flight attendant suffered injuries to her face and lost 2 teeth after she was assaulted by a passenger. People are just acting a fool out there.
wait, we need to rewind for a second. We got off on a tangent.
Yeah.
So my question is, could oil be considered one of the trades of the decade?
There you
Is
go.
that where we're getting to here? One of them, because there's probably many of potential.
I guess commodities in general, right? And like, I don't know, would you trade oil, or would you play that at any certain time?
I would play it through energy equities just because that's how I tend to. The hard part is, energy futures. You've got a time component to it, so you've got to bet that a certain price, something hits a certain price by a certain date. Typically with energy futures, and there's that whole storage requirement and weird stuff like that in the energy futures market. So I tend to, as an equities guy, to play it through the stocks, the underlying stocks that'll get operating leverage from higher oil prices. But I mean, I see the merit in it. I know some smart macro guys that have gone long some longer dated crude futures contracts that are like 2-3 years out. So I can see the merit in it. The hard part with crude too is that you know, it can be in the short run, it can be subject to some pretty nasty supply demand imbalances. So if Iran comes out, you know, or if the Saudis come out and add supply or something happens on that front, you know, you could have the price get crushed by 10 or 15% for a couple months, right? So
yeah, there's a lot of manipulation that happens in that market. Also, we can look at CPI. So this is kind of like, you know, after you have asset inflation, then you get consumer price inflation, and it feels like we're kind of at the early stages of that. I think we may have talked about this in the previous show, but we had the highest reading over like the past 5 or 10 years, starting to creep up. What would you say about CPI? Is there anything we can pull out of here?
yeah, I mean, I think the one thing that I do want to say that sort of relates to what we were just talking about with energy is when you look at correlations between inflationary environments and energy prices, the correlations are pretty high. I believe that's because energy is such an important input commodity, or has been historically, into so many different parts of the economy, especially when it comes to, you know, physical goods and manufacturing. So, you know, I think that's something that concerns me with regard to like longer term inflation, is that if we do get a pretty significant bull market in oil prices, I think that's going to correlate pretty heavily with CPI and with just general. You know, people like to look at CPI ex food and energy, so they like to strip that part out. But in terms,
volatile.
yeah, but in terms of the actual like real human impact, I like to look at overall CPI, and I think like. I think we probably will see it cool off like later in the year as some of the year-over-year comparisons get easier. But then I think if we see oil prices, you know, on a longer-term upwards trajectory, I think this thing can continue to print 3-4+% for the foreseeable future. But the CPI's got a lot of issues too with how it, you know, prices the basket of goods that represents the average consumer and things like that, right? So.
What's the other? So this is RINF, inflation expectations, which has really started to tick up. How is this calculated?
So this is essentially, it's hard to figure out, like the price doesn't map to like a specific asset, because essentially this is an ETF that invests mostly in like TIPS, Treasury inflation protected securities. So bonds that essentially build in the rate of expected inflation. But anyway, RINF, the higher it goes, the higher inflation expectations are essentially, which is reflected in the TIPS market. So a rising RNIF ETF essentially shows you what's happening in the TIPS market, and it suggests that the inflation expectations are rising.
Yeah.
So, and this focuses on later dated or longer dated inflation protected securities. So this does show you kind of longer term inflation expectations.
30-year?
Yeah, generally.
30-year TIPS.
Yeah, generally.
So, okay, so we've talked about commodity prices. We've talked about, you know, consumer product prices going up. What is this really driven by is, I guess, what the Fed is doing and printing all this money, right? Over the past year, we've had $5 trillion in new US dollars that have been printed. And then there's another 6 trillion coming over the foreseeable years.
Yeah. So here's where it gets interesting, right? It's not just what the Fed balance sheet looks like on an aggregate basis, right? As we saw coming out of like 2008, 2009, you remember when everybody was freaking out about hyperinflation?
Yep.
Gold went parabolic for, I think, a year or two. Pull up a chart of gold, actually. It'd be interesting.
Yeah, so gold has actually been on a multi-month little pop here, from the lows down in the mid-1600s up to 1900 today.
Just when you thought you were wrong on your trade.
Yeah, exactly.
I like to look at the weekly chart on gold. I feel like this is a much slower moving market than Bitcoin and other cryptos, obviously. But I mean, on a multi-decade basis, and when you look at the weekly chart, this thing is strong as hell.
It is. It looks very strong.
Yeah. I haven't been trading this over the past couple of years. My trade was actually accumulating physical metals through like 2014 to 2019, and then bought the breakout above 1400. But, you know, you can see on the weekly chart, it pulled back to a really nice Fibonacci retracement level. It was right here at the 38, in between the 38 and the 50. And then also bouncing off of the 100-period moving average. So, you know, I think obviously when you start to hear inklings of higher inflation and concerns like that, people move into things like Bitcoin and real estate and gold.
Yep. Yeah, it'll be interesting. This one may have a potential breakout trade at some point if it tests that all-time high.
Yeah, it's a much slower market, right? So I don't trade in and out of this, but if I have a lot, like a chunk of money, like that I'm just going to consider keeping in dollars, instead of just doing dollars, I'll do gold because I can buy and sell it for a 4% premium. So there's a little risk with it, but over time, you know, I don't know. I'd rather hold gold or Bitcoin than just a whole bunch of dollars right now.
Yeah. Yeah, I mean, I think that's interesting. But to kind of go back, though, like if you go back into, this would be the other flip side of the argument. If you go back to like the post-GFC period, call it like 2009, 2010, 2011, 2012, gold went parabolic. People were worried about inflation, and then it didn't really come.
Yeah.
And gold actually, hit its high, I think, in late 2011, and then sold off for a couple of years.
Yeah, it was down like 45%.
Yeah. And so, and this is what Lacey Hunt, who's in the deflationary camp, would tell you. He would say, we're going to see the same thing happen after we get through this immediate post-COVID period. You might have these commodities up right now, but his belief is that you will have a return to overall deflation once we get past that initial supply-demand issue. And then you could see, assets that are inflation proxies trade down. So, there are smart people that are saying that, and it is worth noting that back here, people were worried about inflation, and yields were up for a while, and gold was up for a while, and then it just didn't come.
Yeah.
So what's different today?
Fiscal.
And that's a big part of it. I think a couple things. The energy price thing that we're just talking about. Could we have a structural, longer-term issue with supply because of ESG and activism? And could you have, a new era in terms of fiscal policy? That's where it gets kind of hard because Biden proposed this $6 trillion budget. Obviously, we had all this stimulus in the U.S. and other countries from the COVID period. We know that, some of that is going to be because of what happened during COVID. But going forward, what's the fiscal situation? Well, Biden's coming out with bazookas. He's saying he wants $6 trillion, infrastructure, childcare, alternative energy, blah, 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 blah. Running $1 trillion plus deficits for the foreseeable future, at least a mid-single digit percentage of GDP in the U.S., maybe more. I don't know if they have the votes to get it done. So we don't know yet if that is going to be the norm. They're going to have midterm elections in a year. So I don't know. Like it feels like we're in a new era, that we've entered a new era where fiscal policy is being used to right the things like income inequality and things like that. But can they actually get it done in a politically divided U.S.? That's the question. And then also you've got him proposing higher tax rates, which is going to offset the inflationary impact of these larger budget deficits.
Yeah.
So these are the things that make it really difficult.
Yeah.
I would say it is a very difficult time to predict what's going to happen and position the portfolio in the right way.
Which is why, like I say, we shouldn't predict, right? We should just have a plan for each outcome.
But when it comes to constructing a portfolio and allocating, there is some level that institutions and, professional investors, they are trying to make sure they make the right moves and hedge the right way. And, think there are a lot of things in the pot that are very difficult to predict right now.
Yeah.
And so, I think it's the right thing to always approach your portfolio with diversification, like you've talked about, not predicting. But at the same token, if inflation does take hold for a long period of time, and if the Fed does have to increase rates eventually, I don't know if the equity market is going to handle that very well. Mm-hmm. And that is something that I would want to be properly positioned for. Yeah. Whether by taking profits or, hedging with a short of some kind, or, managed futures is in place to kind of help that, or something like that. I think it's smart to be thinking about it in that way. But you can always kind of protect yourself if you don't want to think about it too much with being diversified. And, have some equities, have some real estate, have some commodities. What is the all-weather portfolio that Dalio is always preaching about, right? Yeah. For this reason, because we really don't know what's going to outperform over the next decade.
Yeah. I am obviously way over allocated to crypto, right?
Yeah.
Compared to like what most people would say is responsible, right? Like I am leaning into that as something that has performed really well over the past decade, and I think is in either environment could potentially outperform, tech stocks, growth stocks, right? Bonds. Like when I look at Bitcoin and I think about, okay, where is capital going to be attracted to in an inflationary environment? Bitcoin is a clear winner there.
I think that is my trade of the decade type of scenario, is for that exact reason. Ethereum and Bitcoin, the big heavy hitters, is because I see that working in it's asymmetrical risk reward depending on where you think these cryptos
Depending on
are
when
going
you
to
get
go
in.
and
Yeah.
when you get in. And then B, I do think that cryptocurrencies like those two could end up doing well in an inflationary environment and just a normal, maybe I won't call it deflationary, but let's say the market just kind of levels out, the spending or the savings ends up getting spent, in the economy, the manufacturing and all of that levels out, and everything just kind of gets back to normal. Say we do see elevated inflation versus what we've seen over the prior decade, but it's just kind of like chilling, maybe it is around 1.5% to 2% for the next, decade or so. We're not deflating. We're just kind of getting back to normal and then just kind of coasting.
Stays stable.
That's kind of a scenario that I see playing out personally.
Right. We could call that like the base case, right? Where nothing too extreme on either side happens. I still think Bitcoin does really well.
We see inflation if you look at what we've seen happen, prior, but it's not like runaway.
Yeah.
It's not crazy.
That's what the Fed wants, right? That's what most of the central banks in developed countries want, is a slight rate of inflation, call it like 2-3%.
Right.
And in that environment, you still get a benefit, I think, for hard assets with a scarce supply.
Yeah.
Allegedly, right?
Yeah, I mean, we'll see. I mean, the long-term market cycle, call it stock to flow ratio, whatever, that's intact until proven otherwise.
Yeah.
And
real
I'm not going to
question-
bet against that, right? But I'm not going to just only hold that asset, right?
Yeah.
A significant percent of my portfolio is allocated to it, but I also add on the layer of tactical entries and exits, right? Like, there's a reason why I sold a pretty large percentage, at least for me, at the top, right? Things got overheated. I pay attention to market sentiment. Even if I'm macro long-term bullish on Bitcoin, I'm going to trade the emotion. I'm going to get a great cost basis and take profit and build that fiat stack at the same time I'm building the Bitcoin stack, right? I want to build it all together, all tides rising.
I guess I try to zoom out, and I think the real question on my mind is, what does this look like for equities and how do I position my equities?
Yeah.
Because I'm not buying bonds right now. No way, Jose. I understand the crypto thesis, and I agree with all of that and everything you say. I actually can see commodities being, along, but where do equities shake out for me? That's what's on my mind right now.
Well, you
much.
manage the equities portfolio, so I'm glad you're thinking that.
I know, but it's almost like it's really tough.
Yeah.
Because I do see a case for a correction, but when I zoom out and I'm thinking long term, I think there are still a lot of companies that have a lot to offer the world.
Yeah.
And they're going to continue to grow even in inflationary environments. They will still likely continue to grow, especially if they can, pass costs off to their consumers.
Yeah.
So I don't know. I guess I'm trying to just zoom out a bit more and not get too hung up on where we're going long term in equities, which is likely going to still be an upwards trajectory. But will there be a lot more volatility along the way? I think yes. I'm expecting more volatility over the next few years personally. And will there be opportunities within that to do quick hedges or, something like they're trade it essentially? Yes. And I think I saw an article in the Wall Street Journal today that was actually talking about that. It was talking about how they're expecting volatility in equities to just get a lot worse than what it has been historically going into this new paradigm of fiscal and inflation and,
Do you
all
guys
of it.
do you guys think indexing underperforms tactical stock picking in an environment like that?
Yes.
Oh, in an environment like that,
Yeah.
yes.
Where obviously, when the stock market's just really in a boring fashion stair-stepping higher like we've done over the past 10 years or so, I think it makes sense to index. But in an environment where maybe the stock market's flat for a couple of years with really big volatility, think like the 1970s, I think if you're tactical, even though the markets are flat, you could actually significantly grow your account by staying out of high risk stuff
Yeah.
and really buying dips on, I don't know, what in that environment, what markets or what sectors do you guys think would overperform?
I'll make a couple of observations right now about the indexes. We've talked about this in the past, but they're pretty heavily weighted towards large tech and technology in general, which has been great for the past decade.
Yeah.
But the indexes are heavily underweighted energy, mining, metals, the stuff that benefits during an inflationary environment that's exceeding inflation expectations. So the indexes could be very vulnerable, especially things like the NASDAQ and the NASDAQ 100, if we get a surprise inflationary type of environment or a persistent inflationary environment. So the indexes have some risk there. Now, that being said, at the very top of most of the large US indexes, you've got Apple, Google, Amazon, Microsoft, which tend to be high margin, relatively probably neutral to maybe a slight positive benefit from overall inflation. So I'm not worried about those so much. But I would be worried about a lot of the concept stocks that are trading at crazy valuations and have, a neutral to negative implications from the inflationary environment. So I think the indexes are poorly positioned for a potentially inflationary environment. And we're at all-time high valuation levels in U.S. indices.
Yep.
So I would be, again, continuing to look at maybe some of the ex-U.S. markets and, also thinking about the composition of your overall portfolio. Are you too heavily weighted in very, very high valuation names that are trading at, multi-year, valuation multiples?
Talking about asymmetric risk to reward, but kind of on the opposite side, look at the NASDAQ monthly chart going back to the crash in 2000. Look at where we are compared to that and what's happened. Really, it was kind of like COVID was like the slingshot, right? Last March, it's up from the lows of last March, up over 100%, right? So, yeah, I mean, I think that's where probably the highest risk is, right? At least in the stock market, is those really highly valued tech stocks, and maybe some of the commodities and other stuff is where you can get the flip side of that.
Yeah. Value versus growth, another area where, value tends to benefit in the higher rate environments versus growth, which tends to benefit from low rates and deflation generally. So
I think that for me too, right now, because I'm going into thinking about allocating some more capital soon, and I'm thinking emerging markets. I'm thinking international, ex-US. I'm trying to get away from the US so much right now. That's kind of just where my wheels are turning.
Okay.
Because I do think there's better risk to reward in those markets right now, and I particularly am very interested in emerging.
Yeah. So EEM, Emerging Index Fund, if you look at this on a monthly chart, look at that thing.
Yeah, and
Looks like it's coiled, ready to break.
you have to be careful with the emerging market funds because they can be very heavily in China. And I'm almost wanting to sure, China, you can have an allocation there if you want to, but I'm almost thinking emerging ex-China. That's where I'm starting to research and think about personally. Because, we've seen China's middle class explode with innovation and technology, and I imagine that same thing is going to start happening in other countries, hopefully.
Yeah, I wish the Nifty in India wasn't Wasn't so expensive.
Yeah. Yeah. Indian stocks are hard to get direct allocation to unless you are based there as well.
But to your point about indexing versus active management, this has been the great debate, kind of recently. A lot of people have been trained just buy an S&P index fund and you'll be okay. And that may shake out fine, but there are definitely a lot of things that are shifting that I think could affect forward returns, majorly. I think that index investors may end up not seeing the returns they've seen historically. And I also think it's totally cool you have to think about some funds don't give you an allocation to certain companies, enough of an allocation. You may have a couple percentage points allocation to a company that you really like. And I'm thinking about indexing with adding in extra allocations to the companies that you want to have more exposure to, that you think will do better long term. That's kind of how I've been positioning personally.
Yeah. Cool. What do you guys think of crypto outside of my opinions?
Yeah, I think crypto, if the inflationary environment plays out the way I think it could, I think it should be a beneficiary. I guess the risk is what happens if we end up in stagnation or deflation. And what does it look like? I think there's still parts of the crypto market that will still do fine because they are producing innovation and there's like new use cases and there's still a lot of money that hasn't gotten an allocation to crypto.
Yep.
So it might be totally fine even in that environment, even on or let's say a very low inflation rate, or 1 to 2% inflation rate environment, probably still does okay.
Yeah.
But really, I think it gets juiced if we get into this environment of higher than expected longer term inflation, then I think it benefits massively. And it's interesting because a lot of crypto does rely on the narrative. A lot of people, especially around Bitcoin as a digital store of value, they believe that it is a way to maintain your purchasing power.
Yeah.
So I think you don't want to see that narrative violated. So you are kind of, I think, hoping, if you're positioned heavily in crypto, for generally positive surprises on the inflation front.
Yeah.
But I think, if I had to guess, I think that's where we're headed. It's going to be a really choppy and volatile. I think surprise upward. Fed takes action. Market reacts. Whether or not it does any good or not is going to be I think that's what we're going to be living with for at least the next 2 to 3 years in at least stock and bond markets, and probably crypto as well, is reactions to what is happening in inflation.
Yeah.
I genuinely think this is what is going to take so much mind share from investment professionals. This is going to be what we're focused on for the next 2 years.
Yeah.
For better or worse.
I completely agree. And I think, the trade of the decade for me is really a continuation of what I've been doing, which is, obviously the narrative for why Bitcoin exists as the best form of money in the history of humanity, I think is solid. There's people that are always going to disagree with that, and that's great. In the short to medium term, I think a kind of an extra layer to this trade, obviously the Bitcoin long trade, is everything that's happening with synthetics, with DeFi, with security tokens, with all that. It's just a continuation of what we've been seeing. One thing that I was kind of surprised by this market cycle, though, is how many people didn't learn the lessons from 2017.
Yeah.
Some did.
Well, let me tell you what I mean by that. Soulja Boy. My God, did you see what he did the other day?
Yeah.
I did, yeah.
So I'm not going to pull up the tweet,
Cringe.
but basically he got paid to promote some shit coin, some scam token, and he actually copy and pasted part of the agreement, them telling if you raise this much money, we're going to give you this split. So celebrities aren't even learning that you can't get paid by scam coins to promote them, right?
Well, they don't know regulatory
right, but
rules.
well, 2017, there were several celebrities that got sued for that same stuff. But this market cycle, same shit happening. Also, rug pulls, blatant scams, right? Like, there's so many things that I see that, like, people should just be able to look at what happened in 2017 and go, oh, let's avoid those things. Nope.
Like Doge
Well, what do you mean?
being back down. You know, like everyone wanted to buy Doge at whatever.
Oh, true.
At the
Yeah.
highs, and now it's,
well, so the hype cycle too is like people buying at the high instead of accumulating during accumulation periods,
Yeah.
right?
That's never not going to be a thing.
they
though.
didn't learn.
Let's
that
be real.
parabolas-
Investors don't like learn.
Yeah.
Well, most don't.
We,
right?
we can
Yeah.
sit here and say buy low, sell high until we literally pass out from exhaustion, and 99% of people will still do the exact opposite, and they'll troll us in the YouTube comments saying, oh, you guys just talk about the blatantly obvious shit. Yeah, it's because nobody does it. It's easy in theory to say, but it's really hard to do in practice, right?
Yeah.
But it's the same thing, you know, the amount of moon boys that were just, you know, encouraging people to take on stupid leverage on these unregulated futures exchanges. Yeah, when price crashes, you're the first one to get liquidated, right? So stuff like that, I'm just like, I can't believe people have not learned these lessons from the past market
I'm not
cycles.
surprised at all. Not only that, so many people were new. This is their first big Band-Aid rip.
True. Yeah, and every market cycle, more people come in that weren't there. So that's why I feel like as a crypto great granddad, like I feel like it's necessary for me to try to talk about these things and just help people avoid them.
You would think that on the celebrity side, they would have advisors around them that would be like, yo, that's some securities
Yeah,
fraud, maybe.
yeah.
Like, you need
Yeah.
to, like, chill on that or whatever, you know?
Yeah, it's mind-boggling, man. But so again, to kind of recap my trade of the year when it relates to crypto, it's long Bitcoin. So my long trade, my long investment, where I buy is accumulation periods, not when price has gone up 6 straight green months in a row, right? And it's up 500% or whatever. That's not where I buy and hodl. Where I buy and hodl is when price is 70, 80% or more off of the all-time highs. The media has stopped talking about it. The Bitcoin obituaries are getting posted again. That's when you buy and hold. Right? When you're mid-cycle or late cycle, you trade. You get into precise areas with set stops or areas that you would cut it off if the trade goes against you, right? And the higher you go, the more paranoid you get and the more you sell. But for whatever reason, a lot of people think you just buy at any price and hodl, which some people can do that. But again, just like we've said this probably 50 times on the show, it's easy in practice, or in theory, but in practice, if you buy and you're down 60, 70%, some people are going to have that moment of pain where they can't take it anymore. And that's usually where the low is, when the most amount of people just capitulate out. So, you know, just looking at the live chart and kind of talking about the live markets, I don't know if we've hit that yet. Like, I am really prepared for much lower prices. You know, we could certainly pivot here and break up above 40K and be back up above the 200 period. But I don't feel like we've hit that capitulation, that moment of extreme pain yet. I still think we're kind of in the hope or like denial phase. So I
think I agree with you.
Yeah. This is unpopular to say. Like, you know,
Very.
anytime I post something bullish about Bitcoin, it always gets hooray and, you know, rah, rah. Anytime I talk about the bear case, you know, and market cycles and panics and stuff, people don't want to hear that. But that's the most profitable time to get in. And that's the trade of the decade for me, is buying when I see everybody capitulating out.
And so you bought the dip recently. Did you scale out any from the dip buy?
No. So I started to scale in on this panic day where we were testing the 200 period, and I'm not going to sell that. So what I'm going to do, though, I actually ran the numbers today, sent an update to our community. I'm in my crypto portfolio, I'm about a quarter cash. So 25 to 30% ish cash. So I'm prepared and I am excited for lower prices. If we get that, my goal is to buy on capitulation with such heavy size that my cost basis, even from those recent dip buys, is much, much, much lower, right? Like kind of the opposite side of that, when you're on the front side of a market cycle, is when back here in 2020, we were building into a long position, you know, from the 6 to 4K drop to the, you know, the 8K breakout to the 10K breakout, and then finally the 12K breakout. I was building into the largest Bitcoin position I've ever had during this time period. So I was, in a way, I was doing the opposite, where I was averaging up into those breakouts.
Yeah.
On the backside of a trend like this, when market structure shifts south, I start to accumulate and get my cost basis lower, so I'm averaging down, right?
Yeah.
And now, again, I'm not your financial advisor. Please don't blindly follow me or try to do what I do. But that's just the way that I think about it. And because you never know where the low is going to be, right?
Yeah.
Like this could be the low. We could reverse and keep going, and then I'll average up again. I'll start buying breakouts.
Pay for the confirmation, essentially, of the break of this short-term trend.
Exactly.
Because you don't know.
Yeah,
It's 50-50
but
for
I
sure.
feel comfortable because I sold so much near the highs. Now I've got all that cash where I can buy back, and the lower it goes, the happier I get. But I know for some people, you're thinking, what? Like, if you're long Bitcoin, why would that be the case? It's because I can buy back at lower prices,
Yeah.
right? Like I love the asset.
You round trip it.
I want to buy it at the cheapest price possible, right? Where everybody else is freaking out and losing their minds and selling and panicking, I'm taking the opposite side of that trade. That's what I've done since 2013, and that's why I've done really well trading this stuff. So I would just encourage anybody that's listening to this, like, just think about like the mental model there, right? If you like the asset and you get lower prices, that's a good thing. Now, you could get value trapped. You could have assets that die. You could have stocks that go bankrupt, right? That's always a risk. But in general, if you do that, you're going to outperform the emotional idiot that just chases because Soulja Boy tweeted at him, you know?
Yeah. Yeah. Yeah, it's interesting though to think about, like, in the context of some of these other inflation plays outside of crypto, like commodities or, you know, energy stocks, things like that. They are, I would say, they're more in the average up phase. Like if you know, if you're looking at them today, they're well off their lows, but I think still potentially much lower than where they can go in many cases.
Yeah.
If we do get into a surprise inflationary environment. There are some other ways, though, I think, to play the, you know, what I was calling like the trade of the decade. If you believe that inflation is going to run more persistent than the Fed believes right now, you know, I think things like Druckenmiller saying, you know, he wants to be heavily short the dollar, and you know that obviously it depends on against what other currencies are you short the dollar, but you know, there's some potential there for some asymmetric trades.
Yeah, like would he short like the DXY, like
I think so, yeah.
to
and he'll-
trade against a basket of other
Yeah,
fiat?
yeah. So there's DXY, which is a basket, and then you could also go short the US dollar against some other currency pairs, whether or not, you know, probably if you're really looking to make this bet, it's probably against something like the CAD or the AUD or
Yeah.
something with heavy commodities exposure, maybe the BRL, maybe the, you know, Brazilian real.
Good one.
So those would be ones where you potentially you know, might be looking.
That's what I don't understand about the short trade on the dollar. It's like, what, you know, to me, the dollar is the best looking ugly dog, right? Like, what would you actually go long against the dollar other than crypto, right? Like, what other fiat currency would you be bullish on?
If you do have, I mean, I guess you could look at other countries on a relative basis when it comes to the size of the deficit, the amount of, you know, when you have resource intensive countries, right? If you're in a commodity super cycle, then you've got countries like Brazil and Canada and Australia are probably going to have actually maybe even narrowing budgets because of their income they're receiving from the increase in commodity prices, higher, you know, rates of employment, things like that. So you could potentially have other countries, at least in the short run, that have just better metrics when it comes to, you know, their money supply versus, you know, government deficits and things like that. So
Interesting.
that's one way to look at it. But yeah, when you look at other developed economies, like most other developed economies like Japan and a lot of the countries in Europe are facing the same issues that the US is
Yeah.
facing.
Yeah.
And so it really is like a question of, is the dollar any worse than, say, Japan, which is
Yeah.
already at much higher debt to GDP levels and things like that.
Yeah.
It's tough. It's tough. Playing currencies is tough. There's so many variables around currencies. I've never really been able to play that market with an edge.
Yeah.
So I don't really ever play it.
Yeah. I have never really gotten into actively trading fiat pairs, it's just, I don't know.
Yeah.
I've never been able to read it either. Well, one thing that I do think is interesting, I wanted to mention this before we moved on from Bitcoin, but a couple hours ago, I tweeted out because I was curious, like, you know, again, my following is a very select group of people, but what would you do? I said, what would you do if Bitcoin sold off to 20K quickly? I thought that was pretty interesting. 58% of people, so over half of people said they would buy in that case. About 6% said they would sell. 30% said that they would hold what they have and make no changes. And then I saw some other comments in here about buying other cryptos or about deleveraging other things. But I did think it was pretty interesting that, you know, 60% of people almost said that they would actually buy if Bitcoin panicked down to 20K.
That's interesting because I've felt that the bounce in the recent sell-off has been very weak. And so maybe people are waiting for that big 20K test again.
Yeah.
I mean, I don't know. There can be a mental side to these round numbers for investors.
Yeah. 20K is the previous all-time high, right? So it'd be a retest of that. It would be a Fibonacci extension to the downside. And it would be at a percentage off the all-time high that I think a lot of people later in the cycle that bought at the highs would capitulate.
They would sell.
Yeah.
They'd puke out.
Yeah,
Basically.
I haven't felt, you know, I keep my finger on the pulse of market sentiment, and we went from euphoria and holy shit, we're all getting rich, that whole thing, to fear overnight. It was
Yeah.
like Elon's initial dumb tweets were kind of the catalyst for the waterfall of FUD, and then China and all that stuff started to happen.
Yeah.
But I still think there's a lot of people holding on to hope. It was kind of like in 2018, going back to the prior market cycle, we had the 6K area, which was, I called this the line of hope, where a lot of people were watching the 6K zone, and this price was kind of like a ball that was bouncing, and each time it bounced lower and lower and lower, and then eventually it rolled over and fell off the table. And that's why that move from 6K down to 3K was so important, because that's where all the final like emotional people capitulated. And at that moment where the most people are freaking out is typically the
It
low.
felt dark back
Yeah.
then. I remember
Yep.
exactly what that was like.
Yep.
And it doesn't feel dark in crypto right now.
No, not yet.
Not saying it has to, because like we said, it doesn't have to. It could totally reverse from here completely.
Sure.
But I think I get what you're saying, and I agree.
Yeah. I just, you know, hey, if we're still mid-cycle and let's say we V-bottom here and we have another 6 months of upside, great. You know,
Yeah.
I've got a heavy position. I'll keep trading breakouts and dips on the way up. But if not, if we're going to either have a big washout or an extended bear market, I'm prepared for that too. And like, I guess that's the biggest thing, is just trying to help people have a plan for no matter what happens. Whereas if you're the one that got over leveraged and you're about to get liquidated, that's a very dangerous spot to be in.
What would that 20K be in terms of percentage from the highs? 70?
Let's take a look. So from the all-time high, that would be about 65 to 70%.
Okay, yeah.
Yep.
That's typically where the real dark times have gotten to, and then
Yep.
that 70% mark is
Yep.
where we've seen those capitulations.
Absolutely. Yeah. And then
I didn't think we were going to see a 70% correction this time, but
it's always possible.
now
That's the thing.
I'm thinking it's
Yep.
possible for sure. And I would say everybody should be preparing here, looking at this price, and get your plan for.
Just say, what if? What if that happens, right? Why would you want to be caught off guard?
Don't assume that it's just going to go up forever.
And you know, the kind of the tipping point for me on the market sentiment side, why I thought we were going to get this deep pullback, was the narrative that was so popular that institutions are here, they're not going to let price dip. You know, we talked about this last week, so we don't have to do it again, but when you have that so ingrained in the mass majority of people's minds, that's where their faces get ripped off. So cool. You guys want to do some Q&A? I think we've been going a little over an hour. Let's see. We talked about inflation. Okay, before we do that, you guys can go ahead and throw your questions in while we're getting prepared. But why don't we just recap, I guess, kind of the idea of the trade of the decade and what the possibilities are, what you guys see, what the probabilities are, and how you're creating plans around it.
Yeah. So admittedly, the title of today's show was a bit of a fake out because we didn't give a trade for the decade.
Not a single, yeah.
Not a single.
But the idea was that the idea behind it was sort of, something that I came up with today, which was if you can nail, we're at a very pivotal moment in time in financial markets. And if you can nail the call about whether or not we are going to have persistent inflation above the Fed's target over the next several years, if you get that call right, then you can make an absolutely F ton of money in pretty much whatever asset class you decide, because everything from bonds to crypto to stocks and beyond, commodities, etc., is going to hinge on what happens with inflation in the next probably 12 to 18 months. So, when you think about the great macro traders of the world, the Druckenmillers, the Soroses, the marquee trades that they've made or the time periods when they made the most money were turning points in global markets. And this is a turning point. I'm basically saying we're at a turning point, and if you can correctly identify either asymmetric trades that play both sides, or if you can actually forecast which side it's going to come down on, whether it's going to be inflation above expectations or deflation below expectations, then that will tell you the trade of the decade, and you'll have opportunities to make a tremendous amount of returns and money.
Yep.
So personally, my bias is I think actually inflation, there's some structural longer term things beyond COVID, the supply demand imbalance of COVID. I think there's some longer term structural things emerging, like fiscal spending, penchant for fiscal spending to try to fix the wealth gap. And then also energy, a structural decline in the supply on energy from ESG and from other factors that could contribute to inflation running above expectations longer term. So I'm concerned on the stock side about that, and I'm trying to find ways to position the portfolio to essentially have that view and for that to create profits.
And I like how you say, like, the quote unquote trade of the decade isn't so much about like trying to right now decide what the asset or what the ticker is. It's getting the theme right. And then inside of that theme, you can have multiple trades of the decade, or you can have your portfolio as a whole. You can structure in a way where you just ride that momentum, and then on a shorter term basis, you could like trade in and out of whatever momentum starts from that theme, right? So crypto, oil, commodities in general, right? Stay away from tech, anything that's, on the NASDAQ that's been flying high.
Like anything that's an equity highly valued, you may want to be careful with that.
Yeah.
Yep.
Not to say that won't work long term, but there could be a rocky road for that.
Yeah. Like Trav said, we're at a big pivot point, and that's why even in the face of euphoric market sentiment, I'm still heavily long Bitcoin, right? I just want to have the lowest cost basis over time and build both the cash and the Bitcoin position so I have more ammo to make my Bitcoin position bigger. And altcoins, right? That's the other thing. Part of this narrative is, I guess, the second narrative is just the layer 2 stuff and synthetics and the next wave of crypto adoption and innovation. There's going to be not just trading opportunities during bull markets, but there's going to be opportunities to get into stuff that has already had a cycle that's going to go into accumulation that during the next pop, that'll give you the biggest upside potential. That's how I think about it.
So that's your trade of the decade.
Yep.
Still, it's crypto still.
Yeah, I mean it's crypto. It's two things. It's Bitcoin as an asset, right? That's kind of it's in its own little world, and then it's actively trading altcoins to accumulate more Bitcoin, and then leaving core positions on the tech that I think has a shot of lasting 5 or 10 years or more, right? Which I think of that like venture level risk. Like, I don't know which ones are going to win.
I mean, it is.
Yeah, exactly. People like to pound the table. Oh, I'm a Cardano fan. I'm a this fan. Okay, great. I get it. I've got some of that stuff, but at the end of the day, nobody knows what's going to win long term. But I'm going to allocate, couple points of the portfolio to some of those things.
Nice.
All right, let's do some Q&A. Questions you guys have? Why couldn't the institutional money keep the price up? Well, it's not that they couldn't, it's that they're not incentivized to. They're not nobody's sitting there saying how do we allocate capital, right? Like Tesla or whoever. How do we allocate capital and then make sure price doesn't go down? No smart investor says that. And anybody that thinks that there's some like conglomerate of big institutional investors that are there just to hold price up in Bitcoin, that doesn't exist. I don't know how else to say that.
That'd be like the worst bag holder move ever, right? That's how you get your risk committee knocking on your door. Even at like BlackRock or something, if you've got tens or hundreds of billions of dollars, you're not just going to keep buying it day after day, trying to prop the thing up and in the hopes that, as your position size grows and grows and grows and the firm starts to freak out, right? Like that's just kind of silly.
Yeah. Yeah. How would you model the impact of Bitcoin having on the price this year? Do you think that mining expenses would have any significant impact on price? Is it even a factor that you take into consideration? It is. Yeah. There's a couple on-chain metrics that we can look at with the cost of mining and how Bitcoin's price actually moves in relation to that. Day to day, I don't give it a lot of thought, but every couple of weeks I'll check in on those metrics and see how it's playing out. The halving it's not a surprise news event. It's built, you could say like halvings are priced in, but they're really not. It just it lends to the expectation of stock to flow theory working over time. So I don't really think about how mining impacts price day to day, but on a long term, obviously it does. I sold all my Bitcoin around 60K because I was buying a house. Congratulations. Would now be a good time to start buying back in? Well, I'm not a financial advisor. I can't tell you what to do. I can just tell you what I'm doing. And anytime somebody asks me like, should I buy Bitcoin here? My answer is always the same, which is, if you're buying high, buy an amount that if price went down by half, you wouldn't freak out and sell the low. You'd have more capital to buy lower, right? Like it's kind of simple.
Yeah, we talked about earlier the possibility of, Bitcoin retesting that 20K level and that being a pretty interesting area technically where, I think some of us would be adding to our positions. And, if it doesn't get there, fine, but that would certainly be, I think, be an area where personally we'd be adding. I would be adding.
Yeah, I would be excited. It depends on how fast we get there too. Like if it's like a slow grind, like I'm not so quick to want to buy dips when it's like a slow bleed. But my rule of thumb is like over 30% in a few days, where you get a true capitulation washout. The bounces on a percentage basis are usually pretty big. Like you can get like 30, 40, 50% bounces quickly. And then I like to take out some and then leave runners, but that's kind of what I'm looking for here. We'll see if it happens, but I don't know. Would you guys leverage buy gold?
I have a gold bull call spread on, which I think is a better way to get some juice in the trade without having to massively leverage up your portfolio or something like that, right? So there's ways to play it where you can get some upside, 3 to 5x type of upside potential while not having to size your position so massive, right? So mine's sized actually relatively small, like low single digit percentage, and me too. Yeah. So if that call spread hits, I could make a couple multiples of the initial capital, but gold's a tough one because it's one of those that is really correlated highly to real interest rates, and so it's not just getting the overall inflation, top line nominal inflation rate right. It's also getting not just getting like the rates side right, but also getting the inflation rate right. So it's actually kind of hard. Like nailing gold and the timing on gold is tricky. So for me personally, I would be wary of like something massively leveraged where I didn't know how much I could lose on it.
Yeah.
In my spread trade, I know exactly how much I have at risk. and it is leveraged in the sense that, like I said, there's some multiples of a potential upside, but there's only the amount I've risked at stake, if that makes sense.
Yeah.
Yeah.
I think that's wise.
I can't get margin called on.
Smart. Yeah.
Yeah.
Yeah. A lot of people abuse leverage, right?
Yeah.
They think it's a way to get rich quick, and then they just get liquidated over and over and over. So if you use it correctly, it can really help you, but most people
Yeah, and let us not forget gold can have volatility, and that can really hurt you if you're, oversized and over levered, and then it can move slow as molasses too, and then
Yeah.
you're, trapped in a trade, and you may have to take a loss on it. So it can be tricky.
don't. Absolutely.
So I like what Travis did with his options spread.
Very cool. Watching Bitcoin's price during a bull market is like being on a psychedelic trip. I agree with that. I just get such a entertainment buzz from watching how people behave during bull markets and the insanity of the masses, and going from euphoria to panic overnight. And it's an interesting experiment in the psychology of money.
Interesting, yeah.
Yeah. Let's see. Gold miners or even GDX is often a better bet than gold or GLD, because even at mediocre prices in gold, there's still a business behind mining. Yeah, what do you think of that? Silver or gold over the miners?
Yeah, the miners have their own issues. It depends on the time frame. I mean, GDX can outperform gold during different time frames, especially in a really raging gold bull market in gold's price. The miners should outperform the underlying gold price, because of the operational and financial leverage. But if you get into kind of a more choppy environment, then it's less clear. So, miners don't tend to be the best businesses, and I see a lot of people get suckered into investing in penny stock miners that a lot of which are fraudulent. So people will get sucked into investing in these tiny little crappy little mining companies. A lot of a lot of them trading on secondary exchanges in Canada or South America. And I've seen a lot of people lose a lot of money doing that. Now GDX, something like that ETF is going to have most of the large gold producers as its holding. So it's less of an issue with that. I think if you expect, it depends on what you expect. If you expect a really strong gold price, probably the miners will outperform in that environment. So if you expect it's less clear, then maybe gold price or some kind of spread trade is the way to go.
Makes sense. Thoughts on this Bitcoin cycle being more of a reflection of the 2013 rally rather than what we saw in 2017? Yeah, so I think one of the big problems or mistakes that people make about Bitcoin's price is they look at prior market cycles and they try to extrapolate exactly what's going to happen today based on what happened in the past. We can look at those things for clues, but no market cycle looks the exact same, right? They all, in hindsight, end up looking different. So I don't know. I mean, 2013, the biggest difference was it was a much, much smaller pool of market participants, right? Institutions weren't in. There were way fewer exchanges, way less liquidity. So the price moves were even more volatile than 2017. I think over time, as Bitcoin grows and matures and has more and more price discovery in more and more parts of the world, it's going to become less volatile and more stable. So on the way up, we only had a few dips that were even less muted than 2017. 2017 was at 7 or 8 dips over 35% or more. So this one is like the first real pullback that kind of, freaked everybody out. But I don't try to guess what's going to happen today based on what happened in prior market cycles. I look at the current price action in the current areas, and I give way more weight to that. And I look at, both the on-chain fundamentals, the technical chart, and market sentiment. Because market sentiment in crypto is such a reliable indicator. Once you learn how to read it. And really what that means is just like going on crypto Twitter and watching CNBC and mainstream media and like just getting a feel for what the vibe is and what people are thinking and how they're feeling. And usually if you take the opposite side of the masses, you're going to make a lot of money. but that's obviously an oversimplification. But it's a combination of all those things. I think just looking at the chart is a big mistake. All right. Are you guys going to do an overseas mastermind somewhere in the next year? Any links to sign up? Yeah, we want to. We're still waiting to see what's open and all that. Where'd we go? We did one in the Cayman Islands. We did one in Amsterdam. Where do you guys want to do an event?
Where do I want to do an event?
Yeah.
Switzerland. But I don't think that's going to work.
Yeah. Why not? We can make anything work.
I want to do an event on Jungfrau or in Jungfrau.
Yeah. Interlaken, the big, beautiful mountains up there.
Yeah.
What about you, Trav? Where you want to go?
That'd be cool. I would anywhere in the Mediterranean or, anywhere in, there's some great places, Southeast Asia,
Greece.
Thailand, Bali, Greece
would
in the
be nice.
Mediterranean, Italy in the
Yeah.
Mediterranean,
Yeah.
Croatia.
Yeah, where do you guys want to go in chat? Let us know. We've done a lot here in the U.S., which is always easy. We were thinking about Miami or Vegas or a city like that that's kind of easy to get to with some fun stuff.
Miami would be cool too because a lot of people could get there and there's
Thailand.
beachy stuff to do and it's kind of a hotbed now for crypto and VCs.
Yeah. Yeah. Cayman Islands was really fun. Yeah, what did we do when we were down there? We had some scuba diving trips. We took everybody out on a catamaran. Yeah.
In addition to obviously all the classes we were doing during the day and
Oh, yeah, that whole thing.
partying at
Fancy
night and trying to
dinners.
make sure
Fancy
we got our work
dinners, yeah.
done during the day.
Yeah, I love it. Let's see. People want to go to Scotland, New Zealand,
Istanbul.
Thailand, Turkey. Yeah, man.
Yeah, we're kind of waiting for more certainty around where we can do an event, right? So there's still a lot of restrictions on travel between countries. So
Yeah.
that's kind of what we're waiting on is a little bit more certainty about where we can actually do something. And we'd love to be able to do one before the end of this year, but we'll have to see if it's possible.
Yeah, just kind of keeping our eye on the COVID numbers. In the U.S., they're coming down really, really quickly. I know Asia's struggling. Europe's doing okay, right?
Europe's doing
getting
great
better.
now. Yeah, Europe is rapidly improving, and even some of the Asian numbers now are starting to show a downwards inflection, but still early. I don't want to get too far ahead on that, but
Yeah.
even Japan's finally starting to get their vaccination rates up quite a bit in the last just couple of weeks. Their rate is still low overall, but it's the rate of change is looking good. So, knock on wood,
Yeah.
things are improving.
Yeah, Japan has a rush if they're going to want to pull this Olympic off.
That's right. Yeah,
Yeah.
They seem late in the game for for doing this, but
Yeah.
supply was an issue, I guess, at some level.
Awesome. What else, Nick? What else do we want to cover? Let me see.
Well, we got a question that I thought might be interesting.
Oh, did I miss
If they tax crypto into oblivion, could this be a problem?
Yeah, maybe. I mean, what would they do above?
Like on the really what it would look like is, they're going to tax crypto the same way they're going to tax, other assets. So it's you're still looking at short-term cap gains versus long-term cap gains rates. It's not going to be like they're going to necessarily target crypto with higher taxes, I don't think, versus like taxing equities.
Yeah.
I don't think that's going to be the case.
I guess the bear case there is they do what they did with like cigarettes, where it's like, all right, you don't want to use our central bank digital currency and you want to use Bitcoin. We're not going to ban Bitcoin, but we're going to slap an extra 20% tax on it or something like that. That would be, I think, really foolish. And we've talked about those
Yeah.
scenarios where I'd be like, all right, I'm out later.
Yeah. Especially if they start to see people leave and renounce their citizenship
Yeah.
at a higher rate.
Yeah, I'm not going to sell the best monetary asset in the history of humanity because a government wants to try to outcompete it with taxes,
Yeah, that would be pretty silly.
Bitcoin's
on their
much
part.
bigger than the US. Yeah.
Yeah, TBD on that. Honestly, the best thing that could happen is more institutional investors getting involved so that you've got the lobbyist money behind it.
Yeah, exactly.
True.
Which sounds like it's gonna possibly happen.
Yeah.
But what I will say is I do think that the IRS is going to be targeting crypto investors more. I know Biden is proposing hiring more IRS employees, a large number of them, to try to tackle getting more tax money out of American
From
taxpayers.
tax evaders mostly, though.
Yeah.
He has talked about targeting cryptocurrency, though.
Yeah.
They have talked about that.
Well, because a lot of people have been evading taxes.
Right. Yeah, exactly. But what I think that could do is just make sure your books are in order and, just make sure you're doing
Yeah.
things the right way
Yeah.
and don't try to be silly.
The capital gains proposed increase in the cap gains tax rates, though, were pretty significant for the Biden budget plan.
Yes.
That's how they want to pay for a lot of it.
Very
And they would be
significant.
retroactive. That was something that spooked a lot of people.
They're talking
Yeah.
about basically,
that's not finalized,
yeah,
but yeah.
and I don't think that's going to actually get voted. I think that would be crazy. They're talking about basically making the higher cap gains rates effective as of April of 2021 of this year. So that is crazy. It sounds like a logistics nightmare to me, but I don't think that's going to get passed. But I think they're just trying to put out there the big guns, like we're going to tax the rich and the crypto tax evaders. And, I don't think that that's going to actually happen, but we'll see. Anything could happen, but
Well, before we wrap it up, is there anything you guys want to say about SPACs or any of kind of the other high-flying equities sectors?
more SPACs.
Oh, we have our love-hate relationship with SPACs. There's a lot of fun to be had in the world of SPACs in terms of trade opportunities, so I kind of love it. And we've said before we love all the new businesses coming public via SPACs, but listen, there's a lot of bad actors in the whole SPAC industry, and so
There's going to be
the
some bad
SEC's
deals.
coming for them. Yeah, and they're coming for them. They're like the SPAC market's actually had a bit of a lull of new SPAC offerings because a couple of reasons. Was hedge funds had to deleverage after Archegos, so they couldn't put on the SPAC arbitrages as much. You had a lot of SPACs that didn't perform so well during the March to May timeframe, so people cooled off on them. But you are starting to see it perk up a little bit. We have a couple of the SPACs that have just recently finished the completion of their deals, like SoFi and a couple others that have been performing pretty well. So we could see, I think,
Skin. Gosh, I wish I would have caught that one
Yeah.
in time.
Yep. So there's been some optimism trickling back into the SPAC world,
Yeah.
which is interesting to see because I think there could be some really interesting opportunities in both pre-deal SPACs and SPACs with announced deals.
Basically, just pay close attention to the sponsor of the SPAC.
Yeah.
make
Quality
sure-
matters, and the way that it's structured. It's like you do have, correct me if I'm wrong, but limited downside. And, it does give for an interesting risk-reward
Maybe
profile.
pre-deal, but post-deal, the downside is not limited
Sure,
at
sure,
all. Yeah.
But yeah, I put on an options trade on a pre-deal SPAC this past week that I alerted to the community that I think is really interesting because it's just asymmetric. I basically define my downside at 10% of the trade, and my upside is unlimited. So risk 10% to potentially have a multi-bagger. I'll take that kind of trade all day long.
Yeah.
On a SPAC that I think has a really good chance to do something transformative. So we'll see. I've got about 8 months for this trade to play out. We'll see how it shakes out.
Nice.
But I love it. It's not a trade I can put a ton of size behind just because liquidity. But yeah, it's a fun one. I really like this trade a lot.
I like the trade. Awesome.
I like the stock.
All right,
yeah, we
guys.
didn't even talk about meme stocks.
Yeah.
There's a
Save
few
that for-
things that we didn't touch
All
on.
right, let's do
but
it.
no, I mean, hey, we've been going for a while. It's up to you guys.
Yeah, let's do it quickly before we wrap up. I think we've been going a little over
The
an hour
meme
and a half.
stocks are going ham again.
I mean,
well,
yeah.
more so AMC mostly.
The AMC situation is hilarious to me.
And they raised more capital. They issued more shares.
Yeah,
Yeah,
recently.
you called the $20 breakout from last week.
Me?
Oh yeah, you were saying it was looking pretty.
But I didn't trade it, so it doesn't count. For
Doesn't
me.
count. Yeah,
I get zero credit.
Predictions don't matter. Did you put skin in the game?
yeah.
Yeah, it's nuts. Is it gonna last? Probably
No,
not.
Not on the long term. It depends on your time frame. I don't know. This thing could go way higher in the short run.
Oh,
but
did you not see the TikTok guy that's saying that AMC is going to go to like $100,000 a share?
Oh my god, that was so cringe.
Oh, it was so cringe. Oh,
So
it
cringe.
hurts.
I saw people trolling saying, yeah, if every public company allocates 1% of their portfolio,
Yeah.
you know, basically borrowing the Bitcoin narrative.
I saw something like if a movie ticket costs $100,000, maybe.
Yeah, the market cap of that would have been like, I don't know, 50 or 100 trillion.
I thought it was
That's it?
50
Larger than the global-
trillion.
Yeah,
I
it's like
think.
Yeah, no, I mean, it was just an absurd number. It didn't make any sense. But, I mean, I think the point that some of these guys are trying to make is that, you know, it's already untethered to reality in terms of valuation. So why couldn't it go up another 10, 100,
Yeah, exactly.
1,000x? I don't think
it's a
gonna do
ticker
that.
at this point. It's a tradable ticker.
It's a vehicle.
Yeah.
It's a trading vehicle at this point. I would not be looking at this being like, I'm going to invest in AMC at
Yeah.
this point. I think that obviously anything that they're going to accomplish from here is starting to get priced in, essentially. I mean,
They've sold-
could a miracle happen? I don't know.
No, they've sold over 400 million new shares since January 1st. They have.
It's a parabolic chart of shares outstanding.
If you look at market cap and enterprise value, it trades for more than double its previous all-time high. That includes pre-pandemic levels. So, like, when you think about the overall valuation of the company, like it's, I believe, around a $20 billion enterprise value today at today's close price. And the highest AMC ever traded before that, I think, was less than a $10 billion enterprise value.
Wow.
The thing only does a couple $100 million of EBITDA in a best case scenario. So, like, I mean, have fun with that. This stock could go to 100 first, but it's going to be down 50% from here at some point in the next year or two. So, hey, I said last week I wouldn't want to be short it, but I certainly wouldn't want to be long it. So y'all have fun with that one.
What's surprising though is GME didn't exactly catch as much wind. I mean, it caught some wind, but it didn't spike as much as I thought it was going to, seeing what happened with AMC.
Everyone's aping their funds in AMC now. you know?
So I don't know. GME is still trying to get off the ground again.
Yeah, kind of like we talked about the level of hope for support on Bitcoin. We've got a level of hope as a resistance break for a squeeze on GME above 280. So
Yeah.
we'll see what happens there. But is it up? Yeah, it's up a little bit after hours.
It's up
Hard
a little
to tell.
bit, yeah. But it didn't, move quite like I expected looking at what happened with AMC. We'll see.
Yeah.
AMC, there's no resistance anymore, right? It's I believe it's at all-time highs. I mean, it certainly is in terms
Or
of
recent.
in terms of market cap. it's at
Market cap.
all-time highs.
Yeah. Let's see on the
There's
chart.
some prior.
it did tag
broke.
all-time high.
But
Yeah.
again, on a market cap or enterprise value basis, it's way above its all-time. I mean, it's at its all-time high, no question.
Right.
Yeah.
Absolutely. Awesome.
boy.
All right. Well, we've all got trades of the decades in our back pockets. Got a macro thesis, got kind of a short-term play in crypto that we can think about. What are you guys doing in the short term, though? Like, have you started taking more profit in equities, or are you just kind of holding what you got, hedges, anything like that?
I'm holding what I got. I'm starting to think about this inflation environment, though, because if again, I'm trying to listen to the deflationists to try to poke holes in why I shouldn't be getting more long things like inflation break-evens or curve steepeners, essentially betting that the 10-year and the 30-year rates are going to go higher. That is something that could be very profitable in the next 6 to 12 months, and as a trade I'm thinking about. But I'm trying to poke holes in it right now. So I haven't really made any aggressive actions there on that front yet, but it's something I'm contemplating. I do have the gold spread trade on, and I have positioned the portfolio to be like pretty well diversified among like value, growth at a reasonable price, special situations. So I'm not like overexposed to like high momentum tech, high beta stuff. So I've already done that. I've already made sure I wasn't overexposed, but as far as now trying to play the upside, like get long more like miners or long these like inflation break-evens or curve steepeners, I'm still trying to like evaluate.
Cool.
I'm not like totally convinced.
Timing matters too, right? Like
Yeah.
you can have this thesis for a while and the timing
Yeah.
just might not be right to ape into something, right?
Yeah.
Yeah, I mean, I've heard some pretty compelling deflationist theories.
Yeah.
You know, I'm still kind of figuring out what direction I'm leaning, but I kind of said it earlier.
Yeah. Well, we'll see what happens over the next several weeks. And I guess with Bitcoin, next several hours to days.
Yeah, Bitcoin's kind of at a little mini inflection point.
Yeah. I mean, the more it coils up, the better, or at least the bigger the moves are typically,
Yeah,
right? We've
I would be
basically been flat for like 2 weeks. We've got a level of hope that we're at right now, and we'll see if we get capitulation or if we get a bear trap.
If we do get capitulation and we go to lower prices in the low 20s, I think that would be really intriguing to me personally for to play that as an asymmetric way to play the inflation scenario when you're buying an asset that's scarce, that's already down 60+% and has potential upside in an inflationary environment. Like, that's something I'd probably get heavier in personally.
Yeah, man, just leave stocks and just come over to crypto full time.
I have some, but not as much as I would have. I would put on some size, I think, if that happened in a brief time period.
Y'all
Yeah.
heard it first.
Yeah, well, we'll see what happens, guys. Look, thanks to White Charts for sponsoring the show. Thanks to everybody for watching or listening to this on the podcast. You can go to wetalkmoney.com, check out our community. You can submit a question for the show. And we'll see you guys next week.
All right.
Sweet.
Thanks to my guests, Nikki and Travis, for being here. I guess you guys aren't my guests. You're my co-hosts. That's what it is. Yeah.
Yeah, we're
Thanks.
co-hosts.
Yeah.
What's up with that?
I don't know. I don't know where I got the guest word from.
Need a
Yeah.
little nameplates.
Yeah. And we got Kevin on the ones and twos back there switching
Yeah,
for
Kev.
us. Appreciate you. And have a great week, guys. We'll see you next time. Take care.